All right, we got the global macro update yet again on the YouTube live. We're going to wait a couple moments here just so people who we notified on the Discord is able to be present for this live event. And we're going to wait a couple more moments here. And in this video, we're going to go over two charts. We don't have a whole lot of economic news to go over here. Couldn't really find anything too important, but we do have two key things that we are going to go over. Just looking here really quickly to look at any potential opportunities for news articles. Not really. Yeah, so not a crazy amount of stuff. We're not going to talk about some individual statistics like, basically, we're not going to look at like single-digit numbers for the economic calendar. We're looking for more larger, more long-term kind of fundamentals. So we're not really finding that. So we're just going to continue with the video. I'm going to start the recording here, and then we will be able to start our global macro update. All right, let's get the recorder. Also, if you have any questions, if you are tuning into our live, you are able to post any question, and if it's relevant to the video, we'll be able to answer that for you. So we're going to start this global macro update very shortly. Well, in like less than 5 seconds. Hello traders, welcome to another global macro update. In this video, we're going to be covering over two charts from the Fred website. One is going to be looking at the total monetary base. This is going to be the amount of money that's in circulation, and you can see the quantitative easing and the increased supply in that chart. And also, we're going to go over the initial claims, which is the unemployment claims filed, and this is presented on a weekly basis. So first things first, let's actually look at the monetary base because that is a little less devastating. We see that, since the chart dated back in 1975, very, very slow, gradual move. And then we see the first three QEs back when they started in 2008. We see first major QE, second major QE, and then the third final QE. They tried to, balance the sheets and try to basically take some of that circulating supply of money out of the circulation. And that kind of created the challenges of 2015-2016 when stocks kind of had the flash crash situation, and then it rallied back up, and we know where we are right now. So let's zoom in a little bit just so we don't get basically all the flat part. We're kind of looking at more or less where we see it right now from around 2000, let's say, and 8, and where we currently are right now. So first things first, let's get our snip, and then let's discuss what we can see on this chart. So let's move that here. So this is in the millions of dollars. We can see that at the left side. This is going to be right here. So this is the y-axis, and then the x-axis is going to be the date. So we can see right here, I'm just going to make this a little bit bigger because it's very hard to see. Let's do lime. So we see the highs here where there was the most amount of money in circulation in the monetary base. So this is the amount of printed money. And then we tried to get a little less in the balance sheet here, basically, and they tried to normalize the balance sheet, which basically means try to reduce the amount of money in the circulation supply. And clearly they did not get very far when they were back in 2008. They were saying, yeah, we'll try to normalize the balance sheets after QE. If it went from 800,000 to 4 million, and then it got to 3.2, and then now they're probably going to be just exponentially increasing this from this point onwards. We can see already it's basically a straight line we're seeing here, and it's not looking too far from what we initially saw in 2008. Now remember, this is the beginning of 2008. We didn't see quantitative easing measures until the middle of the Great Recession there. And we can see they still haven't created this gray zone. This gray zone is going to be the recession, and we can see within this chart that they still have not identified this zone as a potential recession. So we can see last time in 2008, This was the so-called worst part of it in the Great Recession, but we've been printing money well beyond that all the way into 2015. Now, what does this mean? This means that in the future, if we do get out of this zone, which is the recession's potentially even depression zone, central banks could still keep printing more and more money. We can see the worst of it right here, 2008, 2009, but even the aftermath, they're still trying to stimulate the economy. And in my opinion, they're going to keep on doing it because we see in 2008, it worked phenomenally. The stock market boomed. There's basically, it was a, brush off your hands. Whoa, that was a close one. I'm really glad that worked. And let's just go on our merry way. But now, this time, we have 0% interest rates already just here. They didn't put 0% interest rates until way later in the recession last time, and we already have the balance sheet up here. Before, in the last recession, it was all the way at 800,000. Now, when it's just starting, it's at 4 million. So there's already a huge discrepancy here before we even are starting the real recession, in my view. This is just, in my opinion, sadly, the tip of the iceberg. And now, obviously, you can't use market structure and price action for this, but we see the trend is now shifted where we're getting a shift in trend where we're getting these nice trending lower lows and lower highs. And now we got an aggressive rip right up to the upside. Now, what does this remind you of? Something along the lines of here. So I do think that we will be printing a lot more than what we currently are seeing right now. This is just a drop in the bucket compared to what there is left to come, in my personal view. Now, remember, this is the $6 trillion stimulus bill that they've talked about, right? So this is that bill. Actually, I don't know if this represents it because this is in a weekly, and I don't know if that bill is going to come into here. But the amount of money that they've printed is really minuscule and compared to what they are going to be printing, in my view, in the near future. So we will be updating everyone on this chart because it is a pretty important thing to be looking at. This will also tie into our strength and confidence for gold as a potential long, because as the money prints, consumer price index inflation will go up, which is obviously bullish for gold and cryptocurrencies like Bitcoin. So that is going to be the speculation that we're going to be having within this market shift, is we will continue to see the monetary base increase, and this is at a frequency rate of weekly, ending on Wednesdays. So we'll do this at least once a week and give you guys an update of where the current monetary base is, so you guys and girls have a good understanding of how much money they're actually printing. Now, in my opinion, it's really skewed when you're looking at it just from 2008 and onwards, because this looks relatively normal, especially if you go like this. Well, it just looks like a normal chart. But to truly understand the aggressiveness of these QE implementations and of all this, untested policy, it's good to take a step back and look at what quote-unquote normal inflation could look like right here, right? It was still devaluing here. But just imagine the devaluation is in the inflation that we're going to see from this aftermath. We haven't seen it yet, right? We've always talked about the velocity of money being a key contributor in the actual inflation rate of the US dollar and all fiat currencies, to say the least. So what we're looking for is going to be not just the amount of money that is printed, but also the velocity of money. How many times that dollar or that yen or that Canadian dollar is changed hands. That's going to be a key factor in this whole inflationary speculation that we have. So this is the first main chart we're going to be looking at. The second chart, which is pretty unbelievable, is going to be the initial claims for the unemployment, which is also posted on a weekly basis. So last time we talked about this, let's just go back to, let's see if it was, I think 1 week ago. So if we go back to, let's say, I think the 26th, it should, to the 26th. So let's do, maybe we should do that. No, I don't know if we can do that. Okay, I'm just going to leave it as is, where it currently is now. So basically, this is going to be the number of unemployment claims that are given to the government with people who have lost their jobs who need unemployment. So they need to get given money by the government because they don't have another source of income. because they just lost their job due to COVID-19. If they're in restaurant, bars, tourism, travel, basically, all the sections and all the sectors that are affected by this is going to be a large majority of this group. But what we can see is mind-boggling. Like, for me, this chart is just unbelievable. Look, it dates back all the way to 1967, and you know how everyone was talking about 2008? Look at the Big Short, right? Look at the end of the movie of The Big Short. It portrays a situation where there's a ton of people who don't have jobs. There's a ton of people who are unemployed, who are looking for the initial unemployment claims, right? The movie portrays that being a pretty chasmal, a large event, right? It's a significant recession. A lot of people lose jobs, and it's a very key moment in history. Now look at this shit. That's unbelievable. That's unprecedented. 6.648 million people have filed for unemployment insurance, or unemployment insurance. You get paid for not working, or you get paid because you can't work, because you can't find work. But this isn't in total. There's not 6.648 million people in total. This is the number of claims. This is insane. So this is adding on top of what we saw last week, and adding on top of all the people who were already unemployed from, let's say, pre-March, right? So, how big is the United States in terms of population? What, like 300 million, something around there. So this is more than 2.25%. Let's say 2.5. I don't know exact the count of the United States, but over 2% of the entire population just filed for unemployment claims. That's crazy to think about. 2% of the entire. If you know 100 people, 2 of them just filed for unemployment. Think of how the vast ripple effect this will have on the overall global economy. America is a consumption machine. They are a number one consumer around the globe. Now you just have, more than 2% of the entire fucking population file for unemployment, meaning they don't even have enough money to go beyond, a month or 2 months of rent, mortgage, or whatever your living conditions is, car payments if you have that, insurance, gas, phone, food, and whatever else you have, and internet bills and all that stuff. This is scary stuff. So then when people are saying that this is the bottom, you see this number. Like, this is unprecedented. This has never happened before. So how in the world can people who have no money, 2% of the entire population, just filed for unemployment? And it's not 2% of the population don't have a job. It's 2% of the population or more just filed for unemployment. So add up all the 6.6 million people, and then add the additional people that were already unemployed into the bucket of what we can see right here for the people who are currently on unemployment insurance. So yeah, it's a very, very crazy thing to see right here. I do feel for the people that are affected by this. I don't really know what to add here. If you're sitting at home, I do wish you the very best. Use this time wisely. Learn, educate yourself. This chart says it all. This is why I'm still bearish on the overall economy, not just in terms of another small pullback, but it's going to get much worse. And looking at this, like, for example, like, think of the ripple effect it has. Okay, so one person can't pay their mortgage or their Visa bill. Well, it's not just one person. It's millions of people. So then Visa will now no longer get all the money because people are not able to pay off their Visa card payments or their mortgage. Banks get squeezed because a lot of people start defaulting on their mortgages because they just lost their job. And what's $1,200? It's absolutely nothing compared to what a mortgage would cost for a month-to-month basis. And if you don't have that money, what do, right? You don't have an option. So banks are going to get squeezed because they no longer have money. They already have fractional reserve rates at 0%. So you could loan them $100,000 and they could keep $0 of it, loan that $100,000 out, invest it, do whatever they want with it. They can literally do whatever they want with it, really. Under some restrictions and whatnot. But at the end of the day, it's not your money when you give it to the bank. So, be very careful of that, because a bank run could possibly appear. Banks have already talked about, made a video saying you don't need to worry about putting your money in a bank. It's safe there. It's stupid putting money underneath a mattress. It's so safe inside our bank account. That's just asking. That's in my opinion, just like so blunt about the fact that they're in trouble. If they're saying they're not in trouble, they're in trouble. They wouldn't say anything if they weren't in trouble, right? It's a simple matter as that. So not going to dive too much into it. I know it's a little bit depressing or demoralizing, or it's a difficult time for a lot of people, and I understand that. But our job is to give you unbiased information that you might not find elsewhere, or just another take on it. But that is our goal here, and it's not to try to make people feel sad or make people feel upset because they lost their job and they're part of this group. Not at all. We totally feel for you, and we wish you the very best, but we're just trying to give you guys a good understanding of the severity of this event. This isn't a small pullback, and after COVID-19 it's going to be all fine and dandy. There's going to be roses and rainbows and everything's going to smell like peaches. It's not going to play out like that, in my personal opinion. This is going to be, and it's going to get a lot worse. If you think that you're feeling pain now and you're in a really difficult spot, I wish you the very, very best. There is a light at the end of the tunnel, but just this number is absolutely insane. Don't want to talk too much about that. Okay, now let's go on to the charts. Our favorite part of the video, well, at least for me, is going to be the charts, unless there's something super interesting on, but that's definitely what I like to go over. So first things first, like always, let's go over gold and then go to silver, and then just talk about the commodities a little bit, gold and silver ratio, and then we'll finish off with commodities with some WTI crude oil, which did pop up pretty well. Broke a descending trend line. We'll talk about that within the video. So let's take a picture of this gold and discuss the key levels of support and demand, the descending zone that we currently see, and what we could be possibly seeing in the future. Now, we've already talked about this for a while now. And if you want to look at the really longer term picture, our previous global macro update did go back all the way to the weekly and monthly, so it's a really good refresher on where we stand on the long term timeframes. So now to get into the 4-hour chart, some actionable things that we could be looking for in the near term. So first things first, we talked about this resistance being a potential lower high if it does not break above it. That came really perfectly into fruition. So now we're looking at this descending zone, right? We're seeing a high here. Now this is a lower high. What do you see again at this same descending zone? You see another test of this area, right? So for me, it's probably going to reject down and come form a low, even making a lower low possibly. But right now, this is how I view the markets. We're seeing a support right here, resistance. It's going to be a new level of support. We're probably getting a little minor descending triangle right here, where we're getting a descending zone. And we're using that nice horizontal zone that we talked about right here. And once it fails, we're probably going to be testing the 1550-ish range there. But to me, that's not really something that I really want to trade too much. It could be a nice little short from here back to the base if we got a good risk reward. But the major break that I'm looking for is going to be this potential break right here. It's not validated just yet, but we did talk about how we wanted to go to the 2008 chart on gold. And seeing what happened during the 2008 crash. We didn't do that last video. We said we would. So in this video, we actually will go and look back at 2008 and what happened to gold, during that whole crash, and try to understand where we currently are within the markets. But overall, high, lower high, lower high, and it looks like we are potentially going to come back down to this mid-range zone, potentially even test this zone. So in my personal view, like I said before, let's zoom a little bit like so, just like that. All right. So in my view, I think that we could get a pretty significant squeeze here. We see a high, a lower high, a lower high. So this is going to be the descending zone. Now, in my opinion, we're going to have either a horizontal zone that's probably going to be hitting us at 1470, or we're going to see a higher low from this low, and then we're going to form another higher low, and then there's going to be a very, very big, large symmetrical triangle that we do have in edge trading. So that's going to be the potential opportunities that we have. The main thing we're going to be looking at is just this descending zone, and as long as it's sticking below this zone, I'm looking for a little bit more shorts, just holding the consolidation, either going like this or kind of like this. Obviously, we have no confirmation of this ascending zone, so we can't see any of that. So we're right now just looking to see if the price is going to form some level of low. But in my personal view, for the short term, I think we're going to have some bearish momentum to the downside here for this week and possibly even next week. We'll see how it goes. But yeah, the fact that we held this resistance and now we're testing and this resistance yet again, does provide me enough information that I think that the price will continue to go down. A shift in bias will be this zone right here, 1640. If it does form that higher high from this zone, that could just be a pullback for the next leg to the upside, which could be a possibility. And for that entry, we would need to see this trend line break. So that's basically the trades that we're going to be looking for. In my personal view, it's going to keep on going unless this is a significant pullback and we're now ramping up to potentially make the next leg to the upside. If that's the case, that's great to see. And then what we could be looking for is on a smaller time frame, a push, a significant break of this resistance here. So this is going to be the key resistance we want to break for any single longs, in my view anyways. So we want to see a significant higher high form, and a confirmation would be the higher low, holding the previous resistances as a new level of support. Also in confluence with the descending zone, so you do want to give that price a little bit of room to breathe with your stop loss. But at the end of the day, if it does go above this zone, that could be the outcome of gold. But for now, we're holding this zone. So we are either squeezing like this or potentially squeezing like this. Well, obviously, we have no idea if that's going to come into fruition yet. So we got a couple options here. In my personal opinion, it's not something that we want to be looking to enter right now. It just completed a massive push to the upside after that big squeeze there. So we are now just understanding what the story gold is telling us, and I just explained a couple possibilities that we could see. One to the upside, we're really looking only for one thing, and then one to the downside. But in my personal view, I'm going to wait a little bit more until we see a little bit more of a dependable trade plan or trade situation, because right now it's all right, but the only thing I'm really going off of is this zone right here. And because of the massive move to the upside, I'm not really looking to long just yet. I'm just drawing some trend lines, making sure I understand and trying to understand the story that gold is telling me. But that dip definitely showed some weakness for sure. And, just going over some of the economic calendar and some economic stats that we have been seeing. We do look at, let's just give me 1 second here. So this is one of them. This is what we look at for our economic calendar, which is the Econoday. And we look at some things related to CPI, which is a consumer price index, to understand if there is inflation within a certain economy or currency. Because if there is inflation, if the cost of consumer price goods is increasing, there's inflation where people are actually visibly seeing it. And that's what really matters, right? In 2008, there was a lot of quantitative easing, but what inflated? Real estate, stocks, assets inflated, right? And you didn't see the inflation go into the everyday consumer products like food, clothing and all that stuff. It really didn't change much. So in my personal opinion, the real shift, the psychological shift for the investors is when the everyday people will start to see the inflation in everyday regular purchases, clothing, food, you name it, all that stuff. So yeah, nothing really to do right now for gold in my personal opinion. My bias is a little bit short because we made a high, lower high, and now we could make a lower low here. Possibly even just connecting these zones like so. Get a little dip to the downside at 1550. Let's just play this out as an opportunity here just to see how it goes. Pretty nice actually channel here. I'm pretty happy with that. Let's shorten this up because we don't need that. Actually, that's like a pretty good setup, to be completely honest. And then we got our, previous support right there, like so. So then ideally we're looking for a break, pullback validating the previous support, previous resistance, or previous support is new resistance, sorry. Stop loss is at the recent high, and then your take profit is probably going to be around here. So what you're looking for is not just a break, but in my personal view, I'd want to see a break and then some consolidation here before the leg down. So that's the plan. I want to see it break and then hold, let's say like that, below the support right here, below the resistance, below the support, below the resistance. So ideally, we want to see a solid crack below the zone. We do see a minor level of support that we could probably hold, yeah, right around here. So would not be surprised if we got something along the lines of that. And then we might test this zone yet again as a descending zone right here. So we got test, test, test. We'll make it one more. See, kind of like here, we got our first test of this zone, and then we got a second test, and then we move to the downside. Same thing here. This is our first test. We're going to look for that double confirmation after we break. Similar thing here. We made a high, you made a lower high, still testing that descending zone. This is a high. If we're able to make that lower high, then that's a pretty high confirmation trade that we could be looking at, and probably somewhere around there would be the entry. Good risk reward parameters all around for the first take profit that we'd be looking for, somewhere around there, and it's also obviously a support and resistance in the previous price action. So in my opinion, that's a decent trade that we could be looking at. It's too early to be looking for any shorts, in my opinion, right now, but yeah, this could be an option that we could be trading here. Like I said before, I do want to make sure that we are validated by the previous support, which is going to be the resistance. So basically, that's going to be the trade. I will see if it comes to my desired location, but if it doesn't, that's not a problem. If it does, I'll take the trade, but that does look like a decent opportunity in my personal opinion. Yeah, not much more to add on gold. Before we go on to silver, like we said before, I will go over the 2008 crisis and looking at gold and what happened. So let's go to the 4 hour and zoom all the way back out. Actually, let's go to the weekly. And it's this big mess right around here. So let's get our replay. And let's go just before, I guess, the first move. In, I guess, July 2009, right? So let's just quickly talk about the large time frame. So let's say, this is taking a little bit longer, I know, just bear with me here. Peak October 2007. Oops. Peak is October 07. Peak is October 7, July, August, October. There we go. Vertical line. And then the end was March 09. March 09. All right. So now we got the 2008 financial crisis from the peak of the S&P, which is October in 2007, to the very, very bottom at March 2009. So there is our massive full pullback, right? So this is the 2008 financial crisis through and through, from start at the highest point to the low, the very, very bottom point, right? So what do we see, right? This is the thing. We're not seeing gold do anything other than chop. We see a key resistance right here at around $1,000 per ounce, and then we're just seeing chop and chop and chop, right? We're even seeing a descending zone making lower lows and lower highs, and we can connect that zone right there. We get a nice, very clean breakout, pullback, validating the previous resistance as a new level of support, and then you get a strong push to the upside, testing the previous high of $1,000, and then you see the test high again, and let's just play it from this point onwards. And then you start to see the bullish pushes come in. You start to see some consolidation, and then you see a squeeze in the price. This is that squeeze right here. Very, very key ascending triangle pattern right here. So you go from a descending zone, we're making lower lows and lower highs, and then you got a nice validation, which is going to be a key shift in trend. You get a strong push to the upside, testing that previous high, and then you see a higher low, higher low, higher low. Pretty dang bullish in my personal opinion. So let's play this a little bit more. Mind you, this is on the weekly chart. So you got to break out. This, in my opinion, is going to be super bullish. So this is going to be the breakout. You could see a pullback like we see right here, and then you see the extensions go along. Let's just play this on for a little bit longer. But yeah, this is, in my opinion, a great example of not being so fixed mentally on, instant correlations to occur, meaning that if the S&P goes down, you expect gold to immediately go up, or if you see the U.S. federal government start printing money, you immediately start gold and Bitcoin. You start to see gold and Bitcoin go up. That's not the case, right? So it takes time for it to ripple into the rest of the economy or the markets or whatever the case may be. It takes time, right? So you see for the entire bear market in 2008, from the very high to the very low, having three major legs to the downside, you're not seeing gold do anything enjoyable. Zero. A whole lot of chop, a whole lot of uncertainty even in gold, and you only see the true strong extensions of buy pressure when it's after, when the worst is in, when there is zero hope for prosperity, when there's maximum pain in investors, in markets. That is when the shift will start. There's not enough pain. There's not enough damage yet. It just started, right? We're going to see a lot worse before you start to see the investors around the globe go from fiat currencies like the US dollar, which is the world reserve currency right now, go to a fixed supply asset like gold, silver, and cryptocurrencies. So I'm going to stop it there. I'm going to close. Actually, I'm not going to close it. But yeah, I just wanted to give you a good understanding of the structure of the market that we saw. This is the weekly chart, right? So let's even go back to the daily chart. Let's replay this so we're not too far away. So let's just go right before the break there. And let's go to the daily chart. And let's refine this just so we have a nice structural zone that we're looking at. Very nice right there. So from the start of the major bear market in 2008, it took, let's say, 518, let's say over 500 days before we saw a massive bullish move start on gold. So I hope this gives you some sort of perspective as to the time frame, that we're looking at when we say that Bitcoin, gold, and silver is bullish when inflation starts, when the economy starts to tumble, right? It doesn't happen instantly. But if we close this chart, we can see after this moment here, gold went up exponentially for a very long period of time, right? Until around 2015 around. So 6 years of great gains to the upside. Who doesn't like that, right? So that is going to be what we're going to be looking for, but I hope that this daily chart gives you a good understanding of why we're not so bullish on gold just yet. Same thing with 2008, very similar structure in terms of, how it's reacting. It doesn't react favorably during the panic because there is a lot of emotion. People want to go to dollars or I guess US dollars, Canadian dollars, Australian dollars, yen, because their other assets are selling so fast, or are going down so fast, like equities, real estate's going down fast too. So they're trying to sell, get US dollars, and Bitcoin is just another risk on asset. And, basically everyone is just wanting US dollars. So that's where we currently are right now. We'll talk about the US dollar index very shortly in this video, but yeah, I'm not going to dive into this too much more, but I just wanted to give you a good understanding of how long it could potentially take before our ideas of a fixed supply asset seeing a lot of buy pressure come into fruition. It takes a long time. There's going to be a lot of panic. Look how much volatility there is in the markets. Massive move to the downside. Crazy swings back up, right? This is because it's just pure mayhem, pure panic, right? People are bullish, oh my God. People are bearish, oh my God. There's news, crazy news happening all the time. There's so much fundamental things that are happening throughout the economy. So there's going to be a lot of uncertainty. And that's what we're seeing right here. And then over the worst of it, which is in March of 2009, that's like the worst part, which is the very, very low. Then you start to see, I guess, investors completely just lose faith and say, okay, I have to put my money somewhere. Gold is going to be the safe haven asset that I'm going to be choosing. And that's when we start to see the huge price increases. So that's going to be my view of the markets. That's why I'm saying later half of 2020, 2021 is going to be where the real price appreciation starts to begin in my personal view. It's not going to happen in the summer of this year. It's not going to be instant. It will take time, but it's going to be worth it. Like, go back on gold's chart from 2008, or go back on Bitcoin's chart from freaking 2016, before the bull run. Start of 2016. To middle of 2016 was kind of the commencement of it. See how much the price went up. It is worth waiting for. Patience is the name of the game. The idea is not to get rich overnight. The idea is to grow wealth over time, systematically, using instruments that you understand. If you don't understand cryptocurrencies, don't trade them. If you don't understand why you're investing or trading gold, don't trade it. So basically, that's going to be my overall view of gold. Hopefully you got something out of it. I'm going to delete some of this. The main reason why we wanted to go over that is just to give people perspective as to how long it could potentially take. It's not going to be instant where if the S&P goes down and if the stock market starts going down, instantly you will start to see gold and Bitcoin act super favorably. No, there's going to be a lot of noise and volatility for the next couple months here. And we gotta understand that. So in that said, that's why we're playing a little bit more safe. As a trader, your goal is to not make money every day. That's not the goal as a trader. The goal as a trader is for you to find the highest probability setups and stick with your rules like you would not believe. You have to be super disciplined and be able to follow a systematic approach of coming to the markets. And you can't, you don't know when you're going to get paid. You're just taking high quality setups, managing your risk super well, understanding exactly what your position sizing and what that entails for your risk. If you're risking the maximum amount, what does that look like against your total portfolio, all that stuff. What does that look like for drawdowns? If you're a person who takes a lot of small losses, you don't want as much of a risk on the total portfolio as a person who takes less drawdowns and all that stuff. But in saying that, yeah, we do have to be a little bit more conservative within this range. So, even for a few months, instead of risking 2%, you're risking 1.5, 1.25, and just reducing that risk a little bit more, because we're living in a time where it's going to be a lot of uncertainty for the markets and you're not really getting a clear trend. This lower high, to me, really shows that we're now going to go in some level of consolidation like we saw in 2008, where we saw the huge bearish lower high, lower low situation. It broke out, it tested the highs, and then it broke out. So I wouldn't be surprised if that is the case now, where we get a series of lower lows and lower highs. Inevitably does break this descending zone, and then we test the highs of 1681, and then you potentially see some higher lows squeezing the price around that 1680 zone, and then you get a breakout, and then you get the huge bullish push that everyone is looking for. So yeah, it's obviously a long ways ahead, but being prepared for a situation that could come is never a bad thing. So now that we talked about 2008, I hope that gives you a little bit more insight as to why we're not instantly looking to long just yet. There is a lot of uncertainty in the markets, and when equity markets are super volatile, there's going to be a lot of people who are going to get margin called, who are going to buy the dip. And, the past 10 years, it's been working. Buy the dip, it's been working phenomenally. 2018 was the best dip buy ever. But at this point, I don't think we're going to rally back up. So there's going to be people who are leveraging long, in my opinion, because there's going to be the perma bulls, and yeah, people might get margin called, and there's going to be more liquidations in terms of crypto. But I think it will get worse, and I think gold will not see the price appreciation people are looking for until the later half of 2020, Q4 2020 maybe, or 2021. So we got a little bit of time before that occurs. Now, if I'm completely wrong, that's totally fine, right? We'll see if the price is breaking. That's very easy to understand, but we do have to have a bias at the end of the day of where the price could be potentially going using our analysis just from previous price action and just being in the markets each and every day. So that's my analysis for gold. It was a little bit rambly, but I did feel like I gave a lot of insights as to why I think the way I think. I really like to look at historic price action. Backtesting is so important as a trader, and understanding what happened in previous situations. Obviously, every bear market is going to be different. There's no COVID in 2008 or 2001. The entire sector of airline, tourism, bar, restaurant, entertainment didn't completely shut down. This is a completely another beast from what we saw in the two previous market crashes. So it's probably going to be worse because, as we saw in the jobs and unemployment claims, it's way worse in terms of the numbers, the statistics for the economic health of the country. So, every bear market is different, but just extrapolating what we got from the past, we can see there is a lot of volatility during the worst part of the bear market. And once kind of the dust settles and the worst is out of the way, then you start to see the massive price appreciations of fixed supply assets, especially with the government printing more money now than ever before. QE123 is literally a walk in the park with how much we're printing now. It looks like it's so insignificant. We're talking about trillions of dollars like it's absolutely nothing. So, not going to go on gold too much further because we've been talking about it for a long time, but I wanted to dive in and give you guys a good understanding of what I think and where it could be possibly going, because I know a lot of people have been talking about gold, and it's a great hedge, but it's not a completely inversely correlated instrument with your equity portfolio. If you wanted that, use options, use shorts to hedge your position or whatever, but gold's not going to be doing that. It's more long-term, over years and years, been able to store value over time. Not in a matter of months. It's not going to give you that sort of perfect relationship with your portfolio that you are looking for. So that is the completion of gold. Let's now go on to silver. So that $14, $15 range, yet again, very, very strong level of resistance. And we can see on silver, we have a first anchor point right here. We have our second touch point and a third touch point. And now we're kind of getting to that point right here, and this is also creating our second top for our double top. We talked about this in the last global macro update, saying that if it does come back to the high of around 1460, pretty good opportunity for a potential short here because of gold and our view on gold. Silver is going to also look like a short as well. I think I'm just going to draw in this trend line to see if that does anything. I don't even think that does, but I just saw it and I was like, maybe if this does something. So not really. to answer that question, we could bring it up a little bit just so the wicks. Yeah, I'm happy with that. So there we go. That's silver. If we see the top here and come back down, a decent opportunity in my personal opinion for a short. Especially when it breaks this ascending zone. That's just total confirmation. You got the double top, you got the ascending zone broken, you got the market structure, and once it passes the 1380-ish range, I don't think it'll take very long for it to go to the 1324 and possibly even the 1188 for a potential move like this. Like, let's say you're entering right here, your stop loss is going to be above the previous high, and then your take profit is probably going to be around here, 4.6 if you want to give that room a little bit. Still 3.5% risk reward, very, very phenomenal in my personal view, and something to look out for. First take profit might not want to be all the way there in terms of the risk reward. First take profit might want to be at a 1311-ish. with a risk reward of maybe 2 if possible. You might not be able to get that. But yeah, I'm definitely a little bit more short on silver in terms of my bias. But that's also coming from gold as well. So yeah, we're going to be pretty patient here. But at the end of the day, it does look like it's going to consolidate here and form a series of lower lows and lower highs potentially for gold, which would then mean that silver is more of a short as well, which is looking pretty favorable with the overall structure that we do see for silver. So that's silver and gold. Hopefully you got something out of that gold and silver ratio. I'm not going to talk about it too much. Weekly chart still has 21 hours left. Now we're getting a pullback. If we zoom all the way out, not a whole lot to talk about. Just huge parabolic move where silver is very undervalued compared to gold. Highest it's been in a very, very long time. So when we do see that rush to precious metals, silver will be very undervalued compared to gold. And seeing this shift to the downside will give you an idea of how much speculation there potentially is within the precious metals sector. Because gold is like the safe haven, less speculative, more stable store of value, and then silver is kind of the more volatile, more speculative instrument for traders when the commodities market is seeing, or I guess precious metals market is seeing some buy volume coming in. All right, so U.S. oil, definitely something that happened that we were possibly talking about for a bullish push here. One thing to note, we got stuffed really hard at $25 with a big wick there. We do have a lot of buy volume, so yeah, there's probably going to be some pullback. But in the bullish pullback, we're probably going to see a bearish minor pullback, if that makes sense. And it wouldn't be surprised if it was around right here. Let's just talk about market structure for WTI crude oil. So we got our low here. We know that around $20 break even is a very strong level of support, right? So we see a base hold, and then we see a high here. So this is a high. This is a higher high. We haven't really formed a higher low, really. So what are we looking for here, right? So we see a double bottom, and then you see a strong push to the upside. Now, what would be a good place that we'd be looking for a possible entry to continue the pullback here on crude oil? Well, in my personal opinion, when we are seeing the consolidation shift from sideways to then potentially a bullish move, what we're looking for is when it breaks a key level of resistance, we're looking for the structure to make a higher high, which would then break the resistance, and then we're looking for a higher low to hold as a support before we make a long opportunity. So that's going to be what we're looking for this trade. And what does that mean? Well, in my view, this is going to be, oops, that was a very poorly drawn line. This is going to be the zone that we're potentially going to retest at. So if the price has come back down to this previous level of resistance right here, this previous level of support, this previous level of support, it's a pretty solid chance that we're going to get a higher low to come in, because we see a low. This is actually a higher low than what we saw previously, so we're already making higher lows, which is bullish. So we got a low right here, we got a higher low, which is going to be right here. We do see a low right here, but I'm looking for a little bit more of a significant low. I see this as just one solid push to the upside, and now we're getting a little bit of a fall, and this is going to be FOMO people, as well as a lot of short sellers getting out, because once they see the bottoming and the failure of it to go lower, a lot of people are going to be taking shorts off at around that zone, which is probably why you're seeing such a huge pop up there. Plus Trump and the fundamental news of him talking to Saudi Arabia and Russia to try to stop the immense amount of supply that is currently going into the market. So some fundamental news, obviously that's not going to be the determiner. Like, it's not like Saudi Arabia and OPEC and Russia are just going to be like, okay, Trump, we're going to do everything that you say. Like, yeah, that has some sort of impact, obviously, but at the end of the day, they can kind of do what they want. Just because Trump said something doesn't mean that they have to abide by his rules. So in terms of oil, I think a good opportunity would be to see if the price is able to come back down after this huge parabolic move. You do see A, shorts are getting out of the market, and B, you do see a lot of buyers entering with this very, very strong amount of buy volume. So you're seeing boom, and then you're going to see a nice pullback, gradual, and then once you see a new level of support hold, probably previous level of resistance, then we'll potentially look for a nice entry. But in my personal view, in and around these zones, I just found it to be too low probability because we haven't seen a real market structure break at all, which would be a break above this high. And if we don't see that, it could just be a fake out and it plummeting back down. But it actually broke to the upside, took a lot of the shorts out of the market, and now we are going to see our pullback, in my view. And we got a nice little zone right here, so wouldn't be surprised if we see something like that, maybe a hold at this zone instead of it actually going and actually breaking out. But yeah, that's kind of how I view the markets right now for oil. I'm going to be pretty conservative, but if we do see a pullback in and around these zones, previous resistance right here, new level of support, that could be a good opportunity for us. And zooming out here, let's just see. The major zone of resistance is basically going to be around $28. If it goes above that, it's going to go to the high right after the gap down of around 35. But I'm going to assume that this $28 range is going to have a lot of sellers at the zone because we see the momentum is very, very to the downside. This is, if you're looking for any longs whatsoever, this is going to be a very, very contrarian counter trend trade. What does that mean? Well, if you're a contrarian trader, you might not think about this, but if you're normally a trend trader, you want to lower that position size. You want to reduce that risk because you're going the opposite way of the trend, right? Higher probability is when we see the price break. Let's say it holds the 28 or it even comes up to the 34 and it holds that zone and we get some level of a reversal pattern, double top, head and shoulders, ascending trend line that breaks the support, descending triangle, descending trend line, ascending triangle. I don't know, a bunch of stuff. Basically, what you're looking for, some sort of reversal pattern here, and then you're potentially going to look for that next leg. First take profit would be the recent low, and then if it goes down below, that would be good for a short opportunity. But for the, let's just look at the 12-hour here. For the small time frame, that's going to be my trade outlook. And also, we haven't talked about this. I just actually noticed this because I saw this wick just protrude out. If we actually go on the 12-hour, this is a pretty actually good reverse head and shoulders. Maybe you might not see it, but when we put in the head and shoulders pattern, I'm sure you will. Left shoulder right here, head right here, and we might get back up there. We don't exactly know. Maybe, right? We don't exactly know. That could be option one. That would be potentially to a push to 34. So then your entry would be like 28, take profit 34. Want to manage risk pretty well. And then here is a second smaller head and shoulders. You might see it at this point. You're seeing from this zone. Oops. Let's get this. This is the left shoulder. Here is the neckline. So it's actually here. So it's already broken. And this would be a better situation for what we've already talked about, where now your entry is going to be at the validation of a support at around $22. First, probably your take profit will want to be at $28 probably. I don't know if you want to go beyond that, but that's probably going to be where you're wanting to take a decent chunk of your profits, which means that your risk can't be too much. And it's probably going to be right around there. So not a crazy risk reward, pretty good, pretty favorable. We got a reward of 28% and a risk of 11%, 10.5%. So you got a risk reward of 2.7, which is pretty favorable. And if you're able to get a potential wick lower, then you're looking really good. Then at that point, we might want to give a little bit more room. But overall, that's going to be the outlook that we're going to have for this possible trade. You got a nice area of take profit at around 28, and then you got a potential head and shoulders pattern that could come into fruition if we get that pullback validating that last right shoulder at $22. If that is the case, in my opinion, that would be a pretty good counter trend trade with lower position size, lower risk, because you're a counter trend trading and you're lowering your position size or your risk reward. You're not looking for those 3.5, 4.5 ones. You're looking for smaller take profits because this is less dependable, and the overall structure and overall sentiment is very, very, very bearish. So you do want to be very, very careful when you are trading counter trend trades, but it doesn't mean that you won't be able to capitalize on some bullish moves to the upside as a counter trend trade. But in my personal opinion, this is just going to be the short sellers getting out of the market. We're probably going to see a pullback, and then once we see that validation, because short sellers getting out of the market doesn't mean confidence for the bulls. It just means that sellers are expecting a pullback, or sellers are thinking that there is going to be soon the completion of the impulse push, meaning that there's going to be now an exhaustion, which is going to be a pullback to the upside. So in my personal view, a little bit more of shorts getting out of the market, because it was literally just after we failed to break the low of $20. So yeah, a lot of people who are short are going to say, okay, the trend is, for the meantime, ended, and then we're going to look for the completion of the exhaustion before the next leg down. And what we're looking for is potentially the entrance of the exhaustion move. So yeah, we'll see how it goes. Going to stick on the 4 hour and 1 hour to view this, but at the end of the day, we just wait, and if there's an opportunity that presents itself, that's great. If it continues going up, that's an invalid pattern, and we're just not going to trade it. Simple as that. All right, so that is my gold, U.S. oil, and silver, or WTI U.S. oil. So that's going to be a better option, in my opinion, than gold and silver for a potential play. For me, at least, it's just a better opportunity, a better trade possibility. Gold's not looking too bad, but at the end of the day, I would like to see the dump to downside, making a lower low, and I'd like to enter on the lower high to get a little bit more confirmation. So that's going to be the trades that we currently have in the market for potential. And then let's now go to the indexes. Going to go to S&P, just mainly looking at the 1 hour and 4 hour. Let's just go and zoom back in. Also, I'm at Brave browser took out all my stuff, so I'm going to put the fib zone back in. I got to refine, not that. Fib retracement. So there to there. Widen that zone significantly so I can see exactly where the candle closure is right there. Really, really making sure you get it on the dot. Candle closure, so that where the daily candle closure of the recent highs, where I like to set it. So right there. So that's going to be the overall outlook for the pullback location. And then let's just get our big red zone like we got in the previous video, like so. Make it red. And there we go. There is our pullback area. So now that we looked at the large time frames, and this is going to be the main take profit for the entry here. So it's going to be some fucking awesome profits. Anyways, let's go on to the 1 hour time frame. We did enter a trade with this trend line right here. Did not hold. This was the trade right around there when it broke out. I did have a stop loss just below that zone, like so. So basically when it broke down below this trend line, I called it quits because we were holding a nice ascending zone like we saw, and it was making progressively higher highs like we see. Let's go right here. Progressive higher highs and a steady stream of higher lows, potentially creating an exponential move because we're seeing an increasing higher highs. Did not come to fruition. We held the $2,600 zone of resistance right around there, $2,630, and we dumped down below the ascending zone of support. So I took off my trade and I said, I don't know what's happening. Let's patiently wait until something I understand happens. Now, in my personal view, this market does look like a reverse head and shoulders. I know there's a lot of noise here, a lot of stuff happening here, but let's just zoom out and take a step back from the large time frames and go on the daily chart, right? Now, what do we see? In my opinion, this is now a very, very clear head and shoulders on the large time frames. Not so much the small time frames, but on the large time frames, you're getting a pretty key, well-respected head and shoulders. If you don't see it, you get your left shoulder right here. You get your head right here. And then this is the second shoulder, which is the right shoulder. And now it looks like as long as we hold above the 2450, we could come back up to the 2650, and then obviously after that would be a breakout to the 2850, 2900, somewhere around there. And that is where we're wanting to see our strong level of sell pressure or supply, and we're going to look for our nice continuation, or sorry, not a continuation, our reversal. Yeah, definitely not a continuation here. We're looking for a reversal at 2850 to 2900 on the SPX. So yeah, not much to talk about TVIX. It's going to drop more. I'm very happy with that. We're going to be averaging in hopefully sub 200s, maybe even sub 150s if the SPX starts to slowly climb up. I would really like if that happened, because that would be a phenomenal risk reward potential for us to be in. In terms of the smaller time frames, you do see the big reverse head and shoulders, meaning that this would be a decent place to enter long, but yeah, I think at this point I'm not going to, just because of the fact that simple as that, I just don't see the dependability there as much. And it does look pretty good on the daily, but for me to look to enter, I need to see a couple more validations of this zone. I want to see it bottom out, so you see a series of lows, and I'd like to see it test this maybe one or two more times. See come back down, and you test again, come back down, and then you get a break. That is when I'd be looking for more of a possible entry. Stop loss just below here, and then your take profit would probably be right around here. And you would be potentially taking maybe some profit maybe here, but at the end of the day, the majority I hopefully will be wanting to take up there. But yeah, definitely not ready to be looking for longs just yet, but in terms of where we could be seeing it, if we do get a couple more rejections of the descending zone, validating it as a nice level of resistance, that could be an opportunity for us to look for a squeeze, because we have edge playing squeezes. But right now, we definitely don't have any real opportunity or entry at this moment in time, so we're not going to do anything. But we'll see where it goes. The reverse head and shoulders does look like a pattern that would push us up to our key level of the retest, which is around the 618 to around 50% retracement level, using the fib retracement tool. But that is going to be the overall outlook that we have for the S&P 500. So yeah, not going to do anything right now. We have a possible entry here, but at the end of the day, we will want to be very cautious of this possible short-term move to the upside. But on the long-term time frame, yeah, go look at the previous video. I'm super bearish. I think that there's going to be a pullback to around 28.20 or something, and then it's going to be an absolute plummet of a drop. Even like 47% from the highs there, and from the all-time high, it's going to be, let's say, oh, come on, let's get our arrow. It's going to be around the 54% range. Around 1500 is going to be where, in my opinion, the next major leg down is going to be hitting, potentially, right? So 272 is the more conservative move, whereas the 618 is the more aggressive, and I do think that we're going to have a more aggressive move, so that's going to be where I'm potentially going to be targeting. So that's going to be the overall analysis for the S&P. TVX, like I said, not really going to do much about. DXY is going to be the US dollar index, comprised of 60% euro, 15% yen, and then the rest is going to be in the other fiat currencies. So let's just take a step back and draw our major structure right here, like so. I think that could be refined a little bit. That's okay, I'm happy with that. And then we got our resistance, which is right here, like so. And we're still within that range. We're still below that zone, and also below our major structural resistance horizontally, which is right around there. So we'll see if it goes above. Like I said, if it goes above, it's probably going to have a strong push to the upside, because a lot of people are wanting to have US dollars. So there's going to be more demand, which would then drive the price up. So we'll see where it goes. I'm just looking at the long-term time frames for the DXY, but it's still good to understand how the US dollar is looking. So that is the completion of the crypto market update. No major pertinent potential opportunities in my view as of this very moment, but that doesn't mean that they will not show up in the short term. Obviously, the markets are very volatile right now. They're moving very quickly, so that means that things can change very fast. You don't see 5-7% moves of the S&P often, and you're seeing them pretty consistently now. 5% moves is crazy to think, but like not a surprisingly big day. So yeah, it's very volatile. So lower position size, give that price room to breathe, and really manage risk. Very important. Got another little zone here for gold. We can see Little final addition on gold. You see a nice little squeeze here, and if the price comes back here, nice little confluence zone, probably going to pop back up, and this is going to be where that nice possible entry is going to be, right around here. First take profit is going to be around 3%, so we got a 3-1 risk reward, looking pretty favorable in my personal view. More confirmation would be a break of this ascending zone, and that would be the highest probability that you'd look to get a move to the downside, connecting the lower lows. So that is the completion of the global macro update. If you do have any questions about the charts that we went over, our system, our method, definitely don't hesitate to ask. We don't mind answering questions at all. If you are just trading, just starting out, we do offer a full one-on-one mentorship with videos, books, trade sheets, trade plans, back testing, Excel sheets, homework, psychology, discussions, if you are struggling with that, really everything you need. So if you are interested in kind of stepping up your game for trading, or if you don't know how to trade the cryptocurrency market or trading in general, definitely a good place to go. And yeah, hopefully we will see you there. Until next time, have a good one, everyone.